Lennar, one of the largest builders in America, reported a 46% plunge in profits. Their stock dropped 15% on that news. Investors are worried about rate buydowns, economic risks, and looming foreclosures that could trigger a housing contagion bigger than the GFC. Welcome back to the channel. I'm your host, Ali. Today is very special. We're going to dissect Lennar's Q3 report showing profits are down 46% year to date compared to last year. Their stock took a 15% hit. We're going to explore temporary buy-down pitfalls. And if you don't know what that is, stay tuned. We're going to explain it. How that could lead to job loss and foreclosures, and how the spillover is going to make this compared or bigger than the GFC. We're also going to dissect Lennar's financial engineering techniques that they and their competitors cook up constantly. And we're going to look at what this means for you and your portfolio if the economy tumbles. Make sure you hit subscribe and hit the bell so that you can get updates like this when things go down. Let's get into it. Okay, folks, point number one is earnings breakdown. Let's get into it. In Q3, Lennar's earnings got crushed. Their net earnings went from $1.2 billion to $591 million. Their earnings per share also got crushed from $4.26 per share to $2.29 per share. The revenue slid by 9% to $8.2 billion. And the biggest loser here is their margins, crushed 22.5% to 17.5%. Their buy downs are averaging 14.3% of their sales. It's crushing their profitability and it's crushing housing prices around the area. This is also eroding their leverage. Point two, risks of temporary mortgage rate buy downs. So we're on the same page. We're going to explain this to everyone. Buy downs boost sales by lowering payments, but it's only a temporary thing. Once that lower rate expires or rates rise, monthly costs are going to go up. Buyers are going to face payment shock. They might face cancellations or defaults. If the rates rebound, incentives costs surge and volume will slump. But so remember, the rates reflect economic fundamentals, not just the Fed policy. And that leads us to point number three, financial engineering tactics. Lennar's land-light model now controls 98% of home sites through options and JVs, shifting land risk off its balance sheet. And let's explain how that works and how they've done it. February in 2025, they spun off a company called Millrose Properties. They moved $5.5 billion in land and $1 billion in cash to that entity. Millrose sells lots back to Lennar, creating an off-balance sheet pipeline. Lennar also raised its dividends to $2 at a time and added $5 billion to buybacks, repurchasing $507 million in Q3. These boost their earnings per share mechanically, but it does not fix the profit squeeze, and it could strain liquidity if the rates climb. And you might ask yourself, well, why would they do that? Because as a home builder, you do not want assets to sit on your balance sheet and die there. It's really bad for business. It means you can't sell your homes. So you artificially move them to someone else who's going to sell them, but you also own that company. Which leads us to the next point. Point number four. Let's compare them to their competitors. This downturn isn't unique to Lennar. D.R. Horton net income fell 24% to $1.02 billion. Their gross margin eased from 24% to 21.8%. Our next example, KB Homes. Their profits fell 21% to $110 million, despite they had revenue beats. So how do your profits drop when your revenues is increasing? NVR earnings declined 17% with cancellations up to 17%. The Toll Brothers saw only 1.3% profit dip, thanks to their 26% cash buying incentives, insulating their margins. All of this deploy incentives and buybacks defensively. Point number five, the economic downturn and the foreclosure spillover. If unemployment spikes, homeowners will default on their buy downs regardless of what the rates are, triggering foreclosures that sell at 10, maybe up to 30% discount. These sales create new comparisons that depress neighborhood values. forcing builders to cut prices or increase the incentives to compete with resale inventory. Meaning, if I live next to you and you had to force your sale on your house because of you lost your job, suddenly my house is now worth $400,000. So the builders building in the same area, they can't price their house at $500,000. The land parcels lose value, backlog shrinks, and lenders tighten their credit, amplifying margin pressure. And this is bad news for everyone. All right, point number 6. Let's look at what we learned from the GFC and how this compares. Home prices in the GFC fell about 33% on average between 2006, say, to about 2012. There was about 2.3 million foreclosures. Today's underwriting is much stronger, and builders run lean land-light models. But aggressive buybacks and dividends could weaken their liquidity cushions. Now, policy response may be less aggressive if inflation keeps going and it limits the Fed easing. The key takeaway from this is foreclosure-driven contagion could cascade through pricing, credit, builder solvency, and even if those builders have better balance sheets. This leads us to the final thing on my list, which is market implications and outlook. While affordability remains stretched, with rates ranging between about 6 to about 7%, home prices are still pretty high. Builders are subsidizing sales with buy downs and price cuts, which is unsustainable if the rates rebound or unemployment rises. Now, stocks can trade and are trading on Fed and labor market expectations. This creates volatility. Quality names like D.R. Horton and Toll Brothers may gain share, but leverage builders risk deeper losses. For investors, it's a risk-reward crossroad. You need to position for rate relief or brace for broader downturn driven by defaults and price contagions. And we got to make sure that you're prepared in either scenario. Thanks for watching me ramble about this, but it has real implications to your portfolio if you're in the home builder stocks. I'm personally not. But drop a comment below and let me know. Is this something that worries you? Are you making adjustments to your portfolio? Make sure you smash the like button and subscribe, and share this with other people who might have home builder stocks. Until next time, stay safe, stay diversified, and I'll catch you in the next video.